Right. Aditya Narain joining us on the show this morning. Aditya, thanks so much for being with us. Lots to discuss, particularly where we're at when it comes to this recovery. It seems that the case count is gradually looking a lot less intimidating, and the mortality rate in India, of course, has been lower than most other parts of the world. We're on track for a vaccine. And on the other hand, we've got forecasts that suggest that next year could actually see better growth than was earlier anticipated. Are you also reading into this optimism? Where do you stand when it comes to the pace of the recovery and the kind of earnings recovery we might then see as well?
So I'd split it into two parts. The first is in terms of how well the economy has done over the last couple of months in terms of the bounce back and production levels. That's quite honestly been quite impressive. It is a little ahead of what we were expecting, right? So the data for August and then for September, that's clearly been good. I think where one needs to be a little bit more watchful is that a lot of this is production side data, a lot of this is supply side data, rather than necessarily consumer offtake. Right, end level offtake, which is where I think there will probably be some balancing that happens between the optimism that you're seeing currently and some realism that I think needs to be observed when you have to get to that balance between supply and demand. So I'd be a little bit more mixed. Impressive so far, but I'd be watchful. I think there have been shifts in demand. There will be a pulling down in demand in general. And so to that extent, I think we've not reached that level of balance between supply and demand, which gives a much truer picture of where we are.
And that's interesting, Aditya, because given the way we've seen that rotation in the stock market to pharma, to IT, versus the traditional banks, financials, it clearly does seem that there's a lot of change that's already taken place, and one's waiting to see how this also evolves going forward. What's your sense? Would you continue to remain bullish on some of the newer flavors, and that too for a longer term? How are you really penciling in the outlook, let's say, over the next year or so?
So again, I think that is something that you need to split, into two halves. One is the nature of rotation. I think that is the nature of markets increasingly, right? So you are going to have that short-termism and those jumps when stuff has underperformed for short periods of time, or the other way around. So I think that's one bit, and I don't think that's going to go away from the market. I think the bigger thing to really look at is the longer term, the more secular trends, both in growth and those that are going to effectively miss out. And I would rather play around that instead of just the ups and downs that happen over short-term moves, right? So in terms of these longer-term moves, I think, whether it is IT or whether it is pharma and more debatably telecom, I think those are the fulcrums along which one should typically play and invest for the medium term, right? And within it, if you have, significant performance at points in time, then you can rotate a little bit around. But I don't think your investment philosophy from a medium-term perspective should be driven too much by, recent outperformance or underperformance. You have to sit on stuff that is moving much, much more aggressively structurally.
Apart from the obvious names, Aditya, in IT, TCS, Infosys, Wipro, HCL Tech, what is the best way to capitalize on this entire digital reboot?
I think at many levels in India, it is typically a little narrow, right? You have the large IT guys, you have the small IT guys, you have a bunch of internet players, and then you have Reliance, and theoretically you can have a little bit of telecom beyond that. So in many senses, I think it's a narrow set within which you effectively can play, right? For us, I think our biggest and most structural call remains with the larger IT plays. We think that is something that is going to sustain for a reasonable length of time. We are at the beginning of a multi-year run, and we are really calling it a techolution, which is really something that we think the economy will fundamentally play along. I think at the second level, you then have the second-tier IT stocks, which again we think from a nearer-term perspective will have a decent amount of momentum because when you have a big wave, the smaller guys tend to incrementally at least gain more over the near term. So I think there will be a certain amount of meat and muscle there too. I think if you drill it down further to pure, domestic internet stocks, they've done well. I think they will continue to hold. but they've had a very, very strong run. And there I would say one can expect a little bit of leveling off simply given the amount of stock performance that they've had. But I think if I were to step back, I think the very good thing from an Indian market perspective is that, this is after a long time that India is, or there's a sector in India which is catching a global demand surge, right? And I think this is going to go on for a fairly extended period of time. I think the supply side gets better with this work from home phenomenon where costs can be kept under control. So I think IT globally is going to do well, and I think the Indians are very, very well positioned to piggyback that.
Aditya, so I'm just going to spend a minute on IT because that's something which everybody is excited about, and the reason I'm spending a lot of time on IT today is that what is the right way to look at IT companies now? Buyback is at play, business is expanding, and if I look at the first two numbers, whether it's TCS or Wipro, the margins have gone back to 3-quarter or 4-quarter high. So is IT in a further P upgrade cycle more than earnings?
At the end of the day, these are big players. Their current revenue growth levels have really been single digit. So I think there are two elements that will play through. One is your revenue growth numbers over the next 3-4 years will go to the mid-teens level. Okay. The second bit is your earnings growth because of operating leverage and because of margins will go to the 20 to 25% levels. And we would tend to believe once you get this mix, once you see growth for a fairly extended period of time, I think you will have multiple expansion also that actually that starts from where it already has moved and it sustains for some length of time. So I think you have that combination of really a long runway of growth, improving profitability. And, because these are companies where the risks are really growth risks rather than balance sheet risks, which you've seen in other growth sectors, I think the willingness to kind of value them up will tend to be much greater. If you go out there and see some IT services companies which are entirely digital, which are some European companies, these guys trade at 45 to 55 times, right? So it is not unthinkable that you will go to a valuations band which is substantially higher than the averages that you've seen over the last couple of years. Now, what that exact level is, it's always hard to call. But I would suspect it is going to be substantially higher than what you've seen over the last few years. I think one other element that you need to keep with the IT space is that purely from an ESG angle, the reality is these are great companies. They generate a lot of cash, they do a lot of social good, they're very big in terms of employment. Their track records from a governance perspective is sky high. So you take all of that into account just from the investing world's perspective also. These are areas where people will want to be much, much more comfortable. And so they will be much more willing to put up a premium.
What is the best way to participate in Atmanirbhar pitch of India? Should you buy a company like Amber, Dixon? Should one go towards BEL or Hindustan Aeronautics? Should one go towards API company? What is the best way to participate in this from a stock market side?
So I would tend to believe that if one were to pick a space that is already listed or is emerging, I'd say the most direct and obvious ones would tend to be, the Dixons, the Ambers of the world, because there are direct cash benefits that are coming through to them. And then I would extend it to the API space because I think that's a space where the second tier demand for India already exists. And so it's the primary one which needs to be developed, which will have an economic logic, and those will actually tend to do very well. I'll be a little bit more cautious in pure substitution plays because, stuff that is based on regulatory arbitrages, those could go every now and then. Stuff that is based on competitiveness and which once it scales up, will have economics of its own, I'd rather play in that space.
Aditya, how is it that you're positioned when it comes to financials? Because many in the market believe that the outperformance in IT and pharma is coming at the cost of banks in particular. We've seen that play out as well. But what is your opinion on whether or not the worst is already in the price? And is it now time to go contra on these financials perhaps?
Yeah, so what we've done is up until till early this week, we were running a pretty large underweight on the financials, and we have just upgraded it to a neutral, right? Now our argument is a couple fold. One is, of course, there's been a reasonable amount of price damage for these stocks, so valuations are relatively more reasonable. Second, I think as far as the underlying asset quality is concerned, you've probably reached some sort of level, right? I don't think it's getting any worse. If anything, it's probably stabilizing at this point in time. I'd say the third element is, do you know the numbers? Do you have enough visibility? Quite honestly, no. But between moratoriums, between restructurings, I think over the next, reporting season, you will have a better handle in terms of where this thing entirely is. And you combine that with the fact that there is no liquidity in the system. You combine that with the fact that a lot of the large banks have capitalized themselves very well. You're sitting in a situation where there is, I would say, the downside risks are modest. I'd also say since the economy has come back a little stronger than what people had expected, there is, fundamental support there. And I think this is the point in time where one gets, much more neutral in one's approach, right? Now, I think the issue is what does it take for someone to get more aggressive and go aggressively overweight either on the sector or on individual stocks? I think the swing element, and you've got to watch for it over the next couple of months, is when you start seeing loan demand come back, when you start seeing the risk appetite of banks to actually put money out there. I think that is the swing element. I'm not so sure it's going to come immediately. I'm not even sure how much demand there will be at this point in time, both from consumers and from corporates. But I think we are sitting in that region where what you have to watch for is not the downside, which has been the story so far, but typically the building up of risk, the building up of books, and the willingness to put money out there. Once you start seeing that happen, I think that's when you can take a more optimistic approach and be more aggressive with it. I would also believe that I don't think there's anyone in the banking system who's ready to jump the gun, right? Because they've had such a poor experience over the last many years. So I think when you do see credit come through, do see credit growth come through, I think a lot of it from a quality perspective should be actually okay. So bottom line, we are no longer negative. I think we are in neutral territory at this point in time. It's a wait and watch for a bit of time. And once you see risk appetite and you start seeing lending come through, I think that's when you need to start getting more optimistic. But we'd wait on that. I think it's a couple of months away.
But are you selective within banks? I mean, is it retail versus corporate banks, any of the clusters that you prefer?
So I'd put it simplistically, I think we'd still at this point in time largely stay at the quality end, the higher quality end. But it's also the point in time where you start taking a little bit more risk. So move down just a little bit, not into small bank territory, but into large banks, which lie somewhere in the middle as far as the risk spectrum is concerned. Quite honestly, between the retail and the wholesale, I would believe, the retail guys are clearly the most protected, but the swing will really come from the wholesale, because that's where demand can be more incremental, more aggressively, and I think that space has taken a lot of weight. But at this point in time, I wouldn't vary it between the two. The only thing is in terms of some of the credit loss expectations that were building up, into this during the moratorium. I think if there has been an easing, it's been more in terms of the retail side than necessarily on the wholesale side.
What about consumption, Aditya? Is that just been put to the side for the moment?
See, I think consumption is in the wait and watch territory, quite honestly, because as I said, a lot of the impressive stuff you've seen on the numbers, that's tended to be on the production side. You haven't got a big enough feel on consumption, particularly the discretionary spend. Now, for a start, you have the Diwali season, which is interesting because I think it'll tell you a very big tale in terms of what has happened to demand. Secondly, I would tend to believe that there'll be two elements to it. Firstly, at an aggregate, it will be a little lower. Secondly, I think you will see skews in terms of where that demand comes. and where it doesn't come or it actually disappears, right? So I think even consumption wouldn't be a broad brush. I think it will tend to be more segmented than it has historically been in the past. And to some extent, some evidence of that is what you're seeing on the real estate side, where housing seems to be doing particularly well, even though it's big ticket, it's large, it's large discretionary spend. So I think what will happen is that the overall levels will be a little lower, but you can have swings within it. You can have segments that actually might surprise. And I think that's what you've got to wait and watch a little bit for. But overall, we've been arguing for a while that there's been a lot of obsession on the level of demand and where it comes back. What you've got to focus a lot on is the shape of demand. Because I think this whole COVID event and what's been building up for a period of time is going to shake the system a certain amount, is going to shake consumption patterns quite a bit. And you will have, I think, fairly large gainers from it. Like stuff like tech and consumer durables are obvious ones, but you might have others. And you just might have losers along the way also. So Diwali is a good time to watch for that. I think people should be going out and spending money. We need to keep our eyes open for it. But I think that's going to be the first dipstick of both the level of demand and its contours.
So, I'm just reading in or taking cognizance of really what you're saying. And I think it's important to address that, and looking also at the target, let's say for June 2021, despite those growth projections on the index, you're still looking at a steady performance up till then as one really weighs up, some of the various data that continues to come in. In light of that then, and I know we've discussed sectors, but would you also say that going incredibly stock specific, maybe even towards the broader markets where there are pockets like a specialty chem and others that have been doing well, would perhaps be a wiser strategy at this point of time, given the kind of divided approach that one's still observing over the next few months?
Yeah, I think that's a very fair way of looking at it. You will have sector thrusts, right? And you will have tailwinds, like we've argued, as a lot, the IT space is going to do particularly well. But even within it, you will have to make the call between some winners and some guys who might win, but they will be laggards. I think the same extends to the entire portfolio. So you will have to be, looking at stocks, both in terms of where their business is focused and where those businesses lie in the pecking order of that industry. So you are going to have a lot of that. I think, what is fundamentally happening is, and I think COVID has accelerated it, is that you've ended up having a narrower economy and therefore you've ended up having a narrower market. And so the difference between stock performances will tend to be relatively high, right? There will be, as I said initially, there will be guys who will do well and there will be guys who just slip off the radar. And I think the trick lies in not just capturing a sector, but also importantly capturing the guy who does well within it. So I think it needs to be a balance, but I think the importance of individual stock picking is going to be actually quite significant.
We appreciate your time. Thank you for joining us and have a great day. Let's take a break, and then when we come back, we'll talk about what exactly is happening in the CV market.